All right, good afternoon, everyone. I hope you're enjoying your summer. It is a beautiful day in Cleveland. Nice, sunny, 70-degree day. I hope it's nice wherever you are. I'm Kristen Lucas, not John Klobasicki. Subbing in for him this afternoon, I'm the Managing Director and Chief Marketing Officer out of Cleveland. I'm joined by John Silvis today. And we're welcoming clients across all of our offices, including Buffalo Grove outside of Chicago, Harrisburg, Pennsylvania, Buffalo, New York, Princeton, and Cherry Hill, New Jersey. As always, it's our pleasure to serve and inspire you and your families based on past feedback. These webinars are scheduled on a quarterly basis, and you'll see leaders from all Fairport offices take turns moderating. The goal of these town halls is to connect you directly with John Silvis, Chief Investment Officer. He'll recap where we've been, his thoughts on where we are today, and what the year ahead might bring. We asked for your questions in advance, and John and his team had prepared slides addressing those and other frequently asked client questions. Be assured that your advisors are in continuous contact with the investment team, and here are some ways that you can be too. You should be receiving Fairport Perspectives via email. We sent one earlier this month. If you're interested in weekly updates, ask your advisor to share our weekly Fairport Market Note. You can also subscribe to Fairport Flash, a monthly podcast available on Apple Podcasts and Spotify. And finally, you can follow the hashtag Investing with Fairport on LinkedIn and Facebook for frequent thoughts on the market and economy. As always, you're muted on this webinar and we're unable to see your faces. But if you have questions, you can type them into the chat window, which I'll be monitoring, and we'll answer as many as we can, time permitting. So without further ado, I'm going to turn it over to John, Chief Investment Officer.
Thanks, Kristen. And I hope, John Klobasicki, if you're listening, I hope you're feeling better. I know we've got a lot going on over the last few months. I was just kind of going back through my head before this and trying to review, where we've been since the last quarter. It seems like we just did this call a few days ago, but the second quarter definitely has moved on pretty quickly. But if see if I can, there we go. If I can, just put some thoughts together as far as what we thought drove the first half of the year and even really what we're going to be looking at in the second half. The first half of the year was really driven by two things, and one is the Federal Reserve and monetary policy, and when are they going to cut rates? We've been talking about that for probably close to a year now. When will it happen? How often? As we started the beginning of the year, most people thought it would be fairly quick, probably in March, and we see several cuts throughout the year. Well, we're halfway through the year. We have not seen a rate cut yet. There's been talk, and I know Chairman Powell's been doing a lot more conferences, and he's done uh, uh, hearings and stuff. So he's definitely been out there. And then the second thing is, and these are kind of tied together, is it just really the direction of inflation? Has it peaked? Which it looks like it's pretty definitive that it had peaked last year. Which way is it heading? It's been heading slowly down. It's not been a straight line. So there's been a lot of headlines where it goes up one quarter or in 1 month and then down the next month. And when I say down, the rate of growth slows. So those two things have really been driving the market. And then all the other global political things that sometimes we touch on, but to be honest with you, there's probably just too many to mention. So it's been a great quarter. We finished the quarter at an all-time high. So just to kind of go through some of the numbers with you, if you look, definitely had a strong finish to 23 last year, and we've been adding those gains pretty consistently throughout this year. We had a small correction in April, which was about 5%. We'll talk briefly about that as we move forward. As you can see in that column all the way to the right, large caps did just around 19% for the year so far, for the first 6 months. Emerging market equities in that light purple box is again started to pick up some steam. But really, if you look down towards the end, fixed income is only up about 0.6%. So we had a year last year where bonds did pretty well at 5%, but we're starting to see it struggle again here in 2024. It's definitely been a large cap slash Mag 7, if you want to call it that. I know we've heard a lot of talk about the high concentration in a few names, and that's definitely been true this year as well. It seems like it's starting to broaden out a little bit, and we'll talk a little bit about small caps because they've definitely had a run here over the last week or two, really since the beginning of the quarter. So we'll talk about that as well. And then, just to kind of give you a little more background, because these are pretty short-term numbers. If you go back over the last 3 years, so from um, June 30th of 21 through the recently completed quarter, the S&P is up about 10% a year. If you go back 5 years, it's up about 15% a year. So definitely we've seen above average growth already over the last few years, and we're seeing that again in the current year. The ACWI, which is the All Country World Index, it's an international equity index that we use here at the firm. Over the last 3 years, it's up about 5.6%, so not as well as the S&P, but over the last 10 years, it's been up almost 11%. Just to put it in contrast, bonds have been down about 3% over a year for the last 3 years, and just about flat over the last 5 years. So you can call that annualized or total. It doesn't really make a difference at that point. So, but yeah, so as I mentioned, we've had a great start to the year. We've had 30 new highs in the first half of the year, over 30 highs. We've actually had a few already in the month of July. In fact, if you see this one, this is a great chart. I thought as we got near the end of the second quarter, I was talking to Matt Logar, our CEO, and I said, history would tell us we're going to see further highs because we've never really seen a peak in June going back to 1950. And sure enough, I think the first day or the first trading day of July, we hit a new high, and we actually were at highs on Tuesday. So again, the streak continues and it remains intact at least for another year. Our guess is we'll see, further highs throughout, at least throughout the next few months and into year end. I don't think the high for the year has been put into place at this point, but we have seen 37 of them, and that's a great reason. Strength kind of begets strength, those things. So you can see there's two circles here. You put the one all the way to the right. That's basically where we finished the second quarter, June 30th. Multiples were about 21 times. There's been a lot of discussions on valuations. I'll talk a little bit more about those as we get into the market discussion. But we finished the S&P at 5460, 21 times earnings, and from the low back in October of 22, we're up about 53%. And again, history would indicate we have more to go in the bull market we're in. If you look over to the left there in the lower left, a lot of comparisons going back to the late 90s, the year 2000 peaked the tech bubble relative to the AI discussion, and they peaked at 25 times. So again, probably not a great comparison, but not near the peak that we saw back in the early 2000s. And another thing about that, most of those companies were not profitable back then. Were highly profitable companies. We're seeing companies moving to the trillions or the $1 trillion market caps, 3 trillion as well. So, but definitely something we're watching as we go forward. Volatility has been held pretty much in check. As I mentioned earlier, we had a 5% pullback in the month of April, late March, early April. But that's really been about it. Since then, we've had a pretty steady move forward in the equity markets. As you can see, all the way to the right there, the red numbers are cumulative decline for the year. So the biggest we've had so far is only 5%. It's starting to feel a lot like 2017, where we went the whole year. Now that was a post-election year. We're in an election year, so it's a little different. Probably a lot of some similarities, but a lot of differences. But back in 2017, we went the whole year without seeing a decline of 3% or more. And so far, yesterday marked 351 days that we went without a 2% correction in the S&P. And the only reason I bring that up is because that's what the post financial crisis previous record was. And as long as we don't see one today, we'll set a new one. So again, very little volatility going into the first half of the year, and we'll see if that holds up as we get more and more into the election coverage and other things going forward. So again, on base, I hate giving baseball analogies because it's not really my thing, but here we go anyway. So if history is a guide, we're still in the first half of the bull market. In fact, uh, we're about 21 months in. As you can see in the far right there, some research from Carson Investment Research is about about 61 months is the average. So call it 5 years, and we're only less than 2 years off the October 22 low. So now, granted, the last one did go 21 months. Um, a couple reasons for that, obviously COVID and a few other things. So I would probably dismiss that one. But if you put it in baseball terms, we're probably like entering the fourth inning as far as this goes. So we definitely have some more time to go there. Expect corrections along the way, and as we get into the seasonalities, we'll talk a little bit more about that. So I thought it was a good opportunity since we're halfway through to go back and look at some of the things we mentioned earlier in the year as far as what we thought the themes would be. We roll these out usually in the beginning of January. And I think we got a lot of them right so far. We thought there'd be more highs in the market to move forward. And as I mentioned already, we've seen 30 new highs. So I think that's definitely been we've been right on that one. I put the return your seats to upright position because we're preparing for a soft landing. That seems more and more apparent. There's not many economists out there that still think we're going to see a recession in 2024. So the consensus definitely shifted here over the last few months. And I think everybody's kind of preparing for that. What is to be expected soft landing? We'll see if that still takes place, but the odds seem to be increasing on that. Interest rates, we thought the 10-year interest rate yield would be pretty much held in check. We saw 5% last year. We thought that would be kind of the high water mark. And so far, that's been accurate. We're down about 4.25, maybe 4.20 on the 10-year. And as Jeff DeGraff, who's one of the better technicians in Wall Street, he thinks the trend is kind of broken on yields, and he thinks we can see 380 sometime in the next few months. And then finally, the artificial intelligence has been a big theme throughout the last really year and a half, 2 years. It seems to be continuing into this year, and most likely will continue next year. I know we're again probably on the early innings in that one as well, and we're on this whole new cycle, and Apple's rolling it out, and you see it everywhere. It's in search engines you use now. So again, I think it's something that's going to be continuing to move forward, and that for us tends to lean more towards the cyclical and defense versus defensive sectors, and that's kind of how we thought it was going to play out so far this year. So just to be fair, kind of where we've gotten it wrong, talked a lot about small caps at the beginning of the year. So far, that hasn't happened. Small caps failed to kind of bounce off or add to their gains they saw at the end of 23. I do kind of feel like maybe I should put this in the too early to tell bucket, because over the last few days, really since the end of the quarter, we've seen a pretty good rally in small caps, and I'll have a chart on that later. So we'll see where that goes. But then the other is we thought the Fed would start cutting rates early in the year, probably around March, which was consensus. And as you can see, they've been in this higher for longer process. But if there has been a shift in tone from Chairman Powell and some of the other Fed governors, Fed Board Governor Waller just came out. He's been one of the more hawkish of the governors, and he thinks maybe September is a good time to start. So there's definitely a little bit of shifting there, and the markets now are predicting almost 100% chance of them cutting rates in September. And then the last one we talked about volatility, and we've seen. I'm going to try to list them all. We've seen elections in India, Russia, which I know you could argue how fair they were, but again, one of the larger countries. Mexico, France, the UK, we've seen a lot of them, and we'll see one in the United States going forward. So that tends to add a little volatility to markets, but again, we haven't seen that so far. So that's kind of how the quarter was. I know it's a longer than normal, but any questions out there, Kristen? Or
No, not so far. Of worth noting, to make John and I feel old, that our summer interns did not get the "You're Killing Me" Smalls Sandlot
right,
reference.
right.
So
Yeah, I've
if
given.
you got that reference on that call,
I quit
You're her
giving
people.
yeah, I quit giving out references to anybody under 40 because most of mine are all movie references and they just don't get them. So anyway,
No, nothing yet.
okay. Right. So where's the economy going? Is you've heard me say on these and other either in client meetings or uh, other areas. I'm a big believer if the economy is doing well, that tends to do well for earnings, and if earnings are moving in the right direction, meaning they're positive, and earnings so far this quarter have been positive, that tends to be a good indication of the direction of the markets, and I think that's been holding up for several quarters now. Second quarter, it's a little early for the Bureau of Labor Statistics to come out with a number yet, but so far the GDP estimates from the Atlanta Fed, and you've heard me say this before, have been fairly accurate. They're predicting around 2.5. Now that's varied at times, but my guess is it's going to be somewhere between 2% and 2.5% GDP growth, which is more than enough to continue to move the markets and the economy ahead. One of the things that does is it feeds into the consumer net worth. And if I had one chart that I use, or if I only use one chart of one of my favorite charts, this is one of them because I think it has a lot in it. But really, as I explained before, consumer net worth makes up two main things. It's the average consumer's house, and we've seen home prices going up here recently, mainly because some of the scarcity of supply, but they've been going up. Everybody's watching their neighbor's house sell and say, "Wow, that's great. That's great for everybody else." And then two is retirement savings or longer term savings, most likely your 401k. And again, the markets have been moving to new highs. So people are definitely feeling more empowered as far as their position and their assets go. And that tends to be a good indicator for forward growth. As you can see, you know, the the rise in consumer net worth tends to be a leading indicator, and as it says down there below, um, for consumer spending. And we have a economy that's 80, 70, 75%, whatever it is, driven by the consumer. So as we can see that go up, that tends to be good. And again, people go out and spend. I guess yesterday was the last day of Prime Days, but people will go out. I'm sure we'll hear some statement that it was the best Prime Day ever, and they sold billions of dollars. So again, I think it's a good sign going forward. The other thing that we do is showing a little sign of softness or maybe slowing is the company surveys. And to me, this is a great real time coincident indicator. And it is struggling a little bit. As you can see on the right side of that blue line, we're down around 50%, just around 48 to be exact. Gets to 45, we'll worry about a little bit more, but it's something we're definitely keeping an eye on. And we have seen that slow down and move into that softer landing or softer economy area. But again, on the flip side of that, people are still traveling. I've had the opportunity to be in 3 different airports in the last 40 days or so, and they were all pretty busy. Restaurants, things like that, seems to be doing well. I know the cruise lines are doing well and the airlines are doing well. So TSA puts out their travel number of travelers, and I think this is a little old because this goes back to the end of May, but I think the new data that came through for 4th of July, there was a record number of people taking flights. So again, a good thing for the economy going forward. Credit spreads, which is another way to gauge the health of the economy, overall health of the economy, continue to be very low. If you see that where the arrow is pointing at the bottom there, we're actually pushing closer to historical lows, and it's a good indicator because if credit's easy to get and people are not defaulting on their credit and the spreads tend to tighten like we're seeing with those, that tends to be a good indication of overall health in the market. This is usually where you'd start to see the cracks first, and we're not seeing that. So again, we think the economy's, while it may be slowing a bit here, has not started to see the cracks or the stress yet. So inflation, the other part I mentioned, monetary policy and then inflation. Inflation continues to come down. I know it doesn't come down in a straight line, and there's some months where it goes a little higher than expected, some a little less than expected. But overall, as you can see in that light blue line, we peaked somewhere around 9% in the middle of 22. Um, and as you can see now, we're printing about 3% headline growth. That's up in the red box there. Core, which takes out energy and food, is at 3.3%, but definitely trending in the right direction. The core PC deflator, which is that last line there, the June number hasn't come up yet. That tends to be the Fed's preferred indicator, and it's below 3%. So one of the things we thought would happen this year, we'd see inflation fall below 3%. I don't know if we get to 2%, but I'm pretty confident we're going to see that as we move into the second half of the year. So all that being said, I think it's either time or pretty close to time for the Fed to cut rates. As I mentioned, the markets are pricing a September cut. They technically have a meeting in July. September is probably the most likely we're going to see that. Then you get close to the election, and there's always issues with that. But again, one of the things the Fed looks at is employment. And as you can see on these lines, in the maroon line is to the left there. It's at 4.1. So unemployment has risen to 4.1. So we're starting to see a little bit of slack in the labor markets, which is another reason or thing the Fed wanted to see before they started to cut rates. And I think that's why you're seeing a shift from Chair Powell on those things. So, overall, I think the economy is doing pretty well. We definitely are probably in that soft landing camp. We think things will slow as we get into the second half of the year. I think we avoid a recession, at least for the next 6 months. 2025 is a little hard to predict too far out, and there's probably a little more signs that, as we cut rates, there'll be different effects on the markets next year. But as we see it between now and the end of the year, we think the economy is in okay shape. Any questions or any comments, Kristen? No? All right. So markets overall, markets are up about 18% at the high, the S&P. This year, we've had a little bit of pullback the last day or two. I think that's to be expected. But one of the reasons we're seeing a little bit of that now is, seasonally speaking, the peak in the market, or the best 2 weeks in the equity markets for the year, are the first 2 weeks of July. So today's the 18th, so we're technically entering the second half of July here. So seasonally speaking, it's probably entering more of a weaker time. So I went back and did a little research, but August through October, so August, September, October, tends to be the worst 3 months for the markets. And it's the worst being it has a return of 0.2%, according to Ned Davis research, and that goes back 40 plus years. So it wouldn't shock me, or I would actually probably expect some type of consolidation or correction as we go into the second half of the summer here. But again, I would look at that as an opportunity, probably more than anything else. And we're keeping an eye on that. But as we get into the next couple of weeks, spend more time watching Olympics and less on the market, you should be okay. So one of the things we follow from a market standpoint is the cycle clock, and this is from RenMac. I know my colleague Mac Muirhead talks about this as well, but it judges two things: the rate of increases in inflation and growth, and as they slow, you tend to move to the lower left of the quadrants there. And historically speaking, we're in a kind of a sweet spot right now where growth is slowing, but so is inflation. And when you get that combination, it tends to be pretty positive for markets going forward. And historically speaking, going back to 1948, you see an average return of about 15% annualized when you're in that area. And that's kind of where we've been for the last few months, bouncing around there. So again, we think there's still a tailwind as far as the markets go going forward. Mentioned valuations. Not much else to say except valuations can stay stretched, but they can stay that way for a while. But it doesn't mean markets tend to peak as soon as they hit that valuation. So as you can see there, that dotted green line, the 1 year standard, the one time standard deviation is about 20 times earnings. We're slightly above that at 21 and a half. But Evercore ISI did a great study on this, and they went back and looked at previous times when the markets were above 20 times uh, forward earnings, which we are today. As you can see on the left there, we're about 143 days of since we've been above 20 times earnings. But if you go back to the two most recent times, one back in the year 2000, and then just basically not that long ago back in 2020 to 2022, they tend to go longer. So periods where valuations can last longer. So uh, how long does it go before the markets peak? And then if you look down in the lower left, again, um, we've seen about 11% returns since we've gotten to 20 times earnings, but the last two times you've seen higher returns. So just because you get to 20 times earnings or valuations start to become stretched, it doesn't mean the market turns around. They tend to last. Markets tend to go past that level of 20 times, go a little further, and markets tend to be extended for a while after that. So again, we're keeping a close eye on it, but at this point, we acknowledge that valuations are stretched, but it seems a little premature to totally ratchet back from that point. Mag 7 still dominating. As you can see here, we have seen a little bit of a resurgence in small caps recently, so maybe this will change. But about 35% of the top 10 companies, and you hear them in the news all the time. Most of them are at $1 trillion valuation or higher. So the top 10 is about 35% of the market. I don't get too caught up on that. I know sometimes you hear that and it's in the paper and it's in the press and they talk about it a lot. I think you take what the market gives you, and at times that you're going to see those things. But as you can see, historically speaking, it had been somewhere between 20 and 25 for most of the time, and then over the last few years, we've seen a move higher. Um, uh, so again, this is another chart from Carson Research, and it talks about not giving up on the bull market just because we've seen pretty good returns over the last few months, or really the last 6 months this year. If you see returns of when returns get above 10% year to date, and you hold that to the middle of the year like we recently have, history would tell you the full year tends to be positive 100% of the time. So that's a positive. But you see further gains 83% of the time, and you see, historically speaking, about another 7%. So just because you hit the middle of the year and returns are pretty good doesn't mean that you're going to see a turnaround there. So we've remained what I would say cautiously optimistic on the markets. I realize we've seen a big run over the last really 2023 and then the first half of this year, but we're in that early stages, like I mentioned before, of the bull market. We're probably in the first third of it, give or take. So I think there's opportunities down the road. I think we'll see some corrections, but overall we're pretty positive on the markets. Still holding out hope on the smalls. We'll see how that plays out as we go forward. But I got a couple more charts, and I'll touch on that in a second. So I'll pause there.
I do have an energy question and a cash question.
Oh boy. Let's go with the cash first.
Okay, all right, good. There is a lot of chatter on the web suggesting the nation is going to eliminate cash transactions and convert to a digital dollar. Um, is this a fairy tale or will this be forced upon us? Is the time for cash over, John?
Yeah, it seems like a loaded question. So I guess my thought is, there's been some talk about having the central bank has a digital currency, and I know some other central banks have done that as well. Um, most transactions don't involve people handing dollars to each other anymore. If you go to the grocery store and even among
We're the
sovereign,
ballpark. It's all
yeah, exactly.
electronic.
Everything's cashless. So I guess the point is, I don't think we're moving to a digital currency anytime soon. I don't know if I'll see it in my lifetime. Could there be a point in time where we all just use some type of ID and it taps into our savings? I think that's that's possible. Maybe that's the outcome sometime, but I don't think there's a undercurrent in the monetary policy or Fed policy that we're going to wake up one day and find out that all cash is worthless and everything's digital. Um, but if I'd have told you 10 years ago, you know, we'd be talking about Bitcoin and trading at $62,000 a coin, you probably thought I was crazy. And so, things can change, but I don't think there's any short-term concern about us moving to a digital currency. Maybe that's something down the road, and I wouldn't put too much thought to it at this point.
Do you always tell your kids to carry cash? I never have cash. That was
So,
a good dad lesson that my dad was always mad at me for not having cash.
so I've given up on that one. I think they all carry like a $20 bill on that thing in the back of their phone.
Yeah.
It'll
Yeah,
slide. But most of them, yeah, no, the thought of holding money and exchanging in money. So some of it's a generational thing too. I mean,
I
again,
think
I don't.
so too.
Yeah, when I was their age, I always had money in my pocket because if you couldn't find an ATM, you were out of luck. But now, um, I was just having this conversation with one of our colleagues. Um, the number of Venmos they go through a day is like unbelievable. So anyway, who knows? But so what was the second
All
question?
right, are you
Energy?
ready for energy?
I think so. Go ahead.
Okay, over time, our need for energy will increase dramatically. Do you have any investment recommendations in this regard, and more pointedly, in nuclear energy?
So the second part, I don't have any investable or actionable ideas in nuclear energy. It, it's a fairly niche market, to be honest with you. The first part, I think I'm going to guess this question's coming from the fact that there's a lot of talk about AI and data farms, and if we're going to be crunching all this data and doing all these things, we need a lot more energy to either produce it or to cool it, all those things. So, if we really do move into a AI revolution where 5 years from now we're using it in a ton of different ways to either increase productivity or efficiencies. I think yes, that there's going to be a need for energy. I don't know what form of energy that will be. Most likely, um, it's more the electrical grid and what it can stand. And I think the most likely choice, and it's my guess, would be natural gas, since we're the Saudi Arabia of natural gas and all those things. But as far as like actual ideas or how we look at it from investment, I think it is something we've looked at. I'm going to talk a little bit about our uh, sector stances right now. We own a couple different energy names over the years. Currently, only own one. We're about market weight or slightly under energy, but I think it's an area where you could see more and more uh, new money flowing. But if you look at things like natural, or look at uh, crude oil, the prices have been fairly steady throughout the year, somewhere around $80. Uh, Not to jump into politics too much, but if we do have a change in um, administrations, there's a likely. I haven't heard the term "drill baby drill" much this time through, but I'm sure that'll be uh, one of the themes. And again, we have plenty of supply, just a matter of getting it to market, which would probably keep rates down. So, um, not looking to make too big of a bet on an energy trade at this point, but I do agree that there's going to be a real pressure on both the energy grid and then just production. So it's something that could be a bigger term theme going forward.
Okay, great.
All right.
Sectors.
So yeah. So as I mentioned before, we've been staying the course of being overweight cyclical sectors versus defensives, mainly because we just feel like the economy is doing well. Um, Again, if you go back to the narrowness of the market, technology has been one of the leaders out there. So we've been overweight technology, consumer communication services, which is the second line down there. I'm sorry, third line down, is very tech heavy as well. So those two areas, industrials, even materials to a certain extent. So that's kind of where we've been overweight sectors. From an underweight standpoint, been more the defensive utilities, healthcare, real estate. I don't know if that's going to change. Some of these will move back and forth depending on which stocks in the market are moving. But generally speaking, that's kind of how we view the sectors. Probably would like to add again more to our consumer discretionary. Um, we also own Costco, which has been a great company, so our consumer staples is a little higher than we'd like. But again, we don't want to sell good companies just to move sectors. So that's kind of where we're at from that standpoint. One of the good indicators is the cyclicals over defensive trade working or overweights working is usually you look at discretionary versus staples. So one is clearly the consumer spending on um, either impulse items or luxury items versus spending just on the staples, which is your laundry detergent and paper products and things like that. So it's been really, if you go back to middle of last year, cyclicals have definitely, or discretionary has definitely been outpacing staples. I've used this chart a couple times, but for me, it's like it's the easiest way to say is that theme working? And so far, it definitely looks that way. And I would argue there's probably a breakout even higher. So um, I don't see us changing that going into the second half of the year, but you take what the market gives you. So as we stand today, that's kind of our thought. Um, we are staying the course on growth. We think growth, we're overweight growth relative to value. A lot of that is because of our overweight in technology. It tends to be a growth name. But small caps are starting to show a little bit of sign of life. And, um, we're kind of staying the course with growth, but we do think they're starting to see some cracks or I guess green shoots would be the right way to say it. So there's some green shoots out there on small caps. We saw over the last few days, and I'll give you a better picture of it here. Small caps have started to show a little sign of life really since after the second quarter. So it's really just been the first 2 weeks of the third quarter. But we've seen a big move up. The bottom part of that with the circle there is the advanced decline. So how many stocks went up relative to how many went down. So when you get an 18 to 1 or 17 to 1, that tends to be a pretty big outlier. And history would tell you that tends to have legs. And when you see those big advancements, markets tend to continue to move in that direction. So we should see small caps again continue to benefit. I think the other thing is why it's been a late trade this year is because a lot of it has to do with that they're beneficiaries of the Fed cutting rates, and most people thought rates were going to be cut earlier this year. You would expect them to do better, but now that we're having clearer and clearer direction that the Fed's likely going to cut in September, you're starting to see that play into the market, and I think that'll play into the second half as well. So that's kind of where we're at today. Where we're looking at the markets. To me, the tougher part is always looking forward. And so I don't know if you have any questions, but I can go over what we're looking to watch or what we have been watching. And this won't shock you. We have an election coming up at some point this second half of the year. I'm fairly confident we will have an election in November. I'm not as confident to tell you who's going to win the election, but I do think we will
That's
have one.
fair.
Yeah. So, I think we're getting, before I get into that, I mentioned 25, and I know it seems like that's a long way away, but as we get into the second half of this year, the market tends to look forward. And, it's too early to forecast recessions for the next 18 months, but history will tell you, the number of months from the last Fed hike to the start of a recession, tends to be somewhere in the mid-teens, the high teens, and we're starting to get close to that number. So it's something we're going to keep a close eye on. These things don't always rhyme like that, but again, I think as we get into the first half of 25, I think we'll take a closer look at that and see where we're at as far as the economic numbers go. So the Fed tends to cut. Fed cuts or reductions in interest rates actually tend to be fairly bullish if you're in an uptrend. So if you're within 2% of an all-time high, which we are today, I can't guarantee we'll be there when the first cut comes. But if we're in that range, that tends to be a good sign that further up further market advances is going to happen. So if you look at this chart, you look at the box down there in the lower right, 12 months after, meaning the Fed cuts rates, hopefully within 2% of the all-time high. 12 months later, the market's up 100% of the time. And that's happened 20 times so far, going back, to the early 80s. And the average is about 14. I don't get stuck as much on the average as I do the fact that it has a positive bias moving forward, meaning the markets have been up 20% or 20 out of 20, 100% of the time. That tends to give you a little bit of indication that there's an upward bias in the next 12 months. 14% would be great, but those things we can't predict. So I'm gonna grab some water. But as I mentioned, in case you haven't heard, there is an election coming up, and I know the last couple days have been fairly crazy as far as with the assassination attempt and the RNC beginning and President Biden getting COVID. So my guess is we're going to see a lot of things in the headlines for the next 4 months or 3.5 months, whatever, how long it is. But when you've seen a re-election, meaning the president's running for re-election, and as of 12/42, President Biden is still running for re-election, that could change as well, but we'll see. Histories tell you when the president's running for re-election, those years in the markets tend to be pretty positive. As you can see, that darker blue line, you get a little bit of a pullback early, which we did see in April. So we're kind of following right along the trend here, and it tends to move upward really until you get to late August. There's a little bit of a pullback, but trends tend to be fairly positive. And as I mentioned earlier, not a lot of volatility, which probably plays into the point we talked about earlier. And then the other one is, I know it's too early, but I get a lot of questions, and as we're doing client meetings recently for the finish of the second quarter, I get a lot of questions about the markets and what's been priced in and what's not. Those things are always kind of hard, but as you can see on the left there, and this goes back to July 11th, so this would be before the shooting. Before the shooting. Prediction markets, and there's actually markets you can go out there and bet them on who's going to win. I don't know if they're legal here in the U.S., but you can definitely see them on the websites, and I know it's a big deal overseas, like I know in the U.K. and stuff. But right now, President Trump's about a 60% favorite relative to President Biden, who's only about 20%, but Democrats fall somewhere in the 40s, early 40s. So we'll see. I'm sure a lot of those things will change as we go forward. But if it was today, it's looking like the most probable outcome, about 50%, would be a Republican sweep. So my guess is when we're doing this in October, those numbers will all be different. So we'll see. But we're going to have a call, I think, sometime in the probably after Labor Day on the implications of the markets and the election. So we'll send some stuff out on that as well. So bigger picture, waiting for an entry point in these markets tends to be futile. Peter Lynch, who used to run the Magellan Fund at Fidelity, is one of the, back in the 80s and maybe early 90s, he was one of the most popular portfolio managers out there, made this statement, which I've used numerous times. Far more money has been lost by investors preparing or waiting for corrections, or even trying to anticipate them that have been lost in the corrections themselves. So that's kind of the way I look at it. I think timing these things is always a little tough. I think if you have money on the sidelines and you have a long-term view or long-term time horizon, waiting is always a tough one. I know I've heard the quotes where there's $7 trillion in money markets waiting on the sidelines. So we'll see how that all flows out in the second half of the year. But we still think things look positive, and we wouldn't be getting too cute as far as timing things. And then really the last thing, again, we get clients that come in, and I won't name names, but some people are convinced the Republicans will win. Some are convinced the Democrats will win. And if Republicans win, the world will come to an end. And if Democrats win, their taxes will be spiked so high that they won't be able to afford groceries. I think, that happens, I suppose that can be your opinion. But really, if you look at the numbers here, staying invested, that column all the way to the right is your best outcome, regardless of who gets elected in November. And if there's any more, I don't think there's a much more powerful um, chart than that. So again, I wouldn't worry so much about who's going to be elected. I'd worry about your time horizon and what your risk tolerance is going forward. So, um, any other questions, Kristen?
No, I love that last slide.
Well, you don't get a lot of questions when the markets hit new highs and it's
Right,
summertime.
exactly. It's
Yeah,
summer, new highs.
yeah. So I'll take that as an indication that everybody's happy. And
Yes.
I appreciate you filling in for John. I hope he does feel better. Annika, I know I don't. She doesn't get as much credit, but I appreciate all the help she's put with us to get this put together. So, if you have any questions, and I say this all the time, feel free to reach out to your advisor. Happy to jump on a phone call. If not me, I have a team of 4 other people. We'll be happy. Any one of us could probably take the call. Uh, WebEx, Zoom. I don't know what else do we use? Microsoft Teams, whatever it might be. So feel free to do that. I hope everybody has a great summer. Safe travels on vacations. Oh, I should probably go through the disclosures, Kristen, so
Oh,
everybody.
sure. Yes. If you want to scroll through those, I can talk about how John is hitting the road. He'll be in Buffalo Grove on September 17th for a client event. He'll be at the Cleveland Fairport Nana on September 5th. More dates will be coming out. You did mention that we're going to do a podcast on elections probably in September.
Mhm.
And then we're putting together a webinar on alternatives in private markets with Robert Picard from Hightower, who we did a podcast with that
Mhm.
many of you were interested and liked. So please stay tuned for that too.
Yeah, no, Robert's great, and he has a ton of experience, and he has pretty much every answer for any question you have. So
Yes, absolutely. I look forward to having him.
great.
So
All right.
that's it for today. Thank you. It's our privilege to inspire you and your family. Thank you so much, John, as always, and Annika. And we feel sincere gratitude for your trust and loyalty, everyone. Take care, be safe, enjoy the sunshine.
Bye.
Bye bye.